All right, everybody, this is RC Peck with Fearless Wealth, and I am testing out something new this week, maybe the next couple weeks, to record my weekly vlog or videos. I'm going to do it live. And anyone who checks in or logs in, you can ask questions to me. I will unmute you after I do kind of the content I'm following. And then I will answer kind of a ask me anything. You can ask me about what I covered, or you can ask questions that are on your mind. So the one thing that I will not do, and everybody needs to be clear, I'm not going to provide any financial advice or anything that sounds like financial advice. This is for kind of training and education and hearing how I look at markets. So with that, I want to tell you what I said I was going to cover when you got the email. Let me tell you a couple of things that I'm covering. Why it's so hard to hold on during a bull market or the whole bull market. Number two, why news is going to kick you out of your position way too early. Number three, why stop losses can often do more damage than help you. And how we're actually designed to take quick profits, literally like how our brains are designed to take quick profits, and how our emotions work against us in an uptrend. So with that, what I want to do is I want to explore those through looking at new all-time highs. So what you're looking at here is the S&P 500 with dividends reinvested on my screen. Let me increase that brightness a little bit. And all-time highs are a sign of stability. Now, are there exceptions? Guys, there's always exceptions to the rule, but the rule is especially when an index or a major asset class is making a new lifetime high. Now, could there be an example? I mean, let me just pull up one. Let me just see what Kodak looks like. So let's just say this was Kodak's lifetime high right here. All right, so clearly this would be an example of where, and I don't necessarily believe it is, but let's just say it was. Clearly that is not a sign of stability. That's a sign in many ways of instability. So there's always going to be examples where it's not true. But given that 0.11, 0.0001% of an example, when you're looking at major indexes or sectors, new lifetime highs are signs of stability. Now I'll pull up GLD2 because the two that I wanted to talk about was just general markets and parts of markets, and also talk about gold too. Gold is very emotional and bull markets are very emotional. So the reason it's so hard to hold on to something is because our brain's actually designed to take quick profits, right? Our brains were not designed to stay on for long bull markets. It feels bad to the brain. So what happens is people who buy newsletters, they're taught to trade, or they're taught to think shorter time frame, rather than can you establish that something is in a bull market, and then can you figure out a way to, ride it for 90% of the move. Now, this is something that I train my training clients to do, so they don't have to figure it out. I already figured it out. But using gold and the S&P are a good example because they are two different types of investments. Now, the S&P is a stock asset, and gold, depending on how you think about it, is either a metal, okay, or it's a currency, a non-fiat currency. But if you look at the screen here, this is GLD. It's an ETF that tracks gold. You can see that there are times where if you don't have a system that can keep you from getting kicked out, during any uptrend, there's going to be these kind of, I'm going to kick people out. Even if you look at Tesla in its meteoric rise, which that may be an example of where new lifetime highs aren't necessarily a sign of stability. But even if you did look at Tesla, I'll jump over to it. There was a 60% correction, 60. That right there is a 60% correction. So it was not a free ride to go from split adjusted about $40 up to about $500. So the market doesn't make it easy. It's not like it's a nice linear 45-degree line that doesn't zig or zag or move at all. These black lines, which are the closing price, they're designed to kick people out. So Guys, whether it's the S&P or gold or bonds, new lifetime highs in major indexes are signs of stability, not signs of instability. Okay. Now, one of the things I talked about in the email was why setting stop losses can often do more damage. And the reason is because what people do, that because they're afraid of losing money, because that's how the brain is designed. The brain's designed to take quicker profits and actually to take bigger losses. Because when you sell out of a position, guys, you sell the hope of winning back. That's why people take bigger losses. And when you're in it, you see that gain, you're like, oh my gosh, let me get that little gain. So the reason why people often do worse when they set stop losses is because they've never been trained on how to set proper stop losses. Now, there were a couple questions that got emailed in around stop losses, so I'll just tell you right now. In all of my research, literally the best stop loss amount is 34%. That's a general kind of across the board number. But each index or each sector or each subsector or sub-index or sub-sub-sub-index or sub-sub-sub asset class or individual stock, they all are going to have their own different actual stop loss because they have different behaviors to them. So the reason why people lose more with stop loss is because what they do is they actually put the stop loss kind of in the middle of the highway. And you want the stop loss where by the time the price hits it, the car is fully off the highway and clearly it's moving in a different direction. But what most people do is they put the stop loss kind of in the middle of a 6-lane highway. So when the car starts moving over, it hits it and they go, oh, it must be time to get out. Which again goes back to how our brain is designed. Our brain's actually designed to take quick profits. And this is why in the email I sent you, why our emotions work against us in an uptrend, because we look at something, and I'll go back to SPY, and I'll bring up a couple other things that are making new lifetime highs. Our brain is designed to think, oh my gosh, it's so high, I got to get out. Now, someone taught you to think that. You weren't born with that idea. I will tell you that. So someone has taught you that something making new highs is a sign of getting out. Now, I'll just quickly run through a lot of sectors here. Here's the technology sector, and that's way above its old lifetime highs. Almost all the price charts I show you here, except if it's an actual index, like a tracking, like the actual index and not a tracking symbol, every black line is going to include dividends reinvested. But you can see that technology has been above a new lifetime high since, let's call it mid-June. So if I go through the 11 sectors, technology is making a new lifetime high. Communications is making a new lifetime high. XLV, which is healthcare, is making a new lifetime high. Materials, which is interesting, is making a new lifetime high too. This had a great, let me get this here, really had to break above a resistance, maybe a 2-year resistance, a little bit more, and finally did. But materials are making a new lifetime high. I'm going through the 11 main sectors of the market. Consumer discretionary is making a new lifetime high. Basically, this is all Amazon in there. But also consumer staples is making a new lifetime high. So out of the 11 sectors, 6 of them are at new lifetime highs. 5 of them are kind of lost in the woods. Here is real estate, not really doing much, kind of lost. Here you have financials, same thing, lost, not really doing anything. You have energy. Interesting thing about energy, in 1980, it was, wait for this, 30% weighting of the S&P, 30%. Today, it's not even 3%. It's about 2.5%. So people who say to you, I'm not going to buy the average, the average is like the S&P 500 average, because then you get an average return, and I don't want to buy the junk. Well, the thing is, first of all, energy is only 2.5% of the S&P, so it's not really going to hurt you. And plus, people are following somebody else's belief system anyway. Okay, so I had that energy. I had, the one thing I did want to bring up is also industrials. Industrials also has not made a new lifetime high. And then finally, to round out with 5 factors is utilities. So 5 aren't making new highs, 6 are. It's good enough for me. And so the reason why people often have difficulties because they're not trained to think with pictures. They're not trained to think with images. And when they're not, the words create these worlds and stories both in our head consciously and unconsciously, and they greatly work against us. So the S&P is at new lifetime highs, so is technology, so is communication, so is healthcare, so is materials, so is discretionary, so is staples. Now, these are the sectors. There are dozens or hundreds of ways to slice and splice and cut the market. So if you guys want me to look at something else, you can just put it in the chat and I can unmute you. Okay, so I got a bunch of questions that were emailed in. And so I want to look at these over on my other screen. If you want to know what I'm looking at those other ones. So Ed, I saw that you emailed something in, and I'm going to unmute you, and I can also see if you can unmute yourself. And if you can't, then I'll just go right to your question. But I got a question from you, Ed. Both you emailed it in and you showed up. So I don't see that you can unmute on your side. So I'm just going to go ahead and ask the question you asked. So this was, hey, RC, how do you time your entry and exits? So look, the word time is a triggering word to people. And so if I were to take the word time out of the question, just say, how do you determine or how do you figure out when to get into something and when to get out of something? The first thing I would say, Ed, is everything's based on price and everything's based on a signal. So my signal to get into any sort of symbol is either going to be a crossing of a moving average. And I have my own proprietary moving averages that I train my clients to use. I did a deep dive on finding out what were kind of the best moving averages. And it's not the standard 200, 150, 20, 10. Those kind of come as kind of default. And so there are much better pairings than that standard. Ed, I can't hear you. I see that you maybe tried to unmute yourself. Oh, there you are.
Yeah, sorry, I missed the button. Can you hear me now?
All right, I can. Did I understand your question correctly about how do you time your entry and exits?
Yes, that's correct, RC.
And when you say time, you don't necessarily mean timing. You just want to know, how do you determine them?
Yeah, I've been following your system using the 68 moving, I forget what you call it now.
That's fine.
But that's more of quite a long-term timing model. And I was wondering if there's a shorter timing model using shorter different moving averages.
Well, I will say this. Let me go to a different price chart. So here's AMD. So if we weren't using moving averages, what I would look for is when a price breaks above something that looks like it couldn't break above it in the past. So if you look at AMD on the screen, can you see that, Ed?
Yes.
So what I would do is I look for areas of resistance, right? So between September of 18 to September of 2020, it looked like AMD could not get above about the $32 mark.
Yeah.
And I could have done this right here and said, look, every time it broke above 31, it failed. But clearly it couldn't stay above really this line here, call it $32. So for me, if I'm going to buy something individually, I want price to agree with what I'm doing. And that means if I buy something, I want price to be going higher. I'll often let price tell me what to buy, right? So I probably wouldn't buy this as it's falling. So as just one way to answer your question, I would look and, you see it again here, price breaks above there. And it doesn't matter what you're looking at. Like we could look at silver too, and we'd see the same thing. Silver could not break above, at least on SLV, really couldn't break above this price point. And then once it did, it exploded higher. So you can see this in many different places. So what I do is I train people how to think with their eyes and not necessarily with their prefrontal lobes, which that means a lot of quote unquote research, but to actually train people to be like, okay, if I want to get into Bitcoin, which is what we're looking at right here, how do I do that? Hold on, let me just pull it up here. How do I do that? And the answer would be, you got to have price agree with you, right? So in my brain, when I look at Bitcoin, it looks like it's had a really hard time staying above, let's call it $11,000. So I look, to answer your question, I look for resistance points. And when resistance points then become support points, that helps. Of course, there's more to it because you have to figure out how much. You have to figure out if there's a safer thing to buy that's outperforming. No need to buy a riskier thing that's underperforming. But does that make sense?
Yes, it does.
Cool. Thanks, Ed.
Thanks very much, Ossie.
All right, guys. So let's see. Let me just see. So Olga, I'm going to ask to unmute. I see that you, I'll do the same thing. I unmuted you on my side, and I'm also going to start to answer your question and give you, oh, you may have just unmuted yourself. So your question, and you can start talking and I'll tell you when I hear you. So your question was, what do you think will happen in the market in September and October? So when you say market, I'm assuming the S&P 500, though we can look at something else. So I mean, I don't do that. I mean, I'll answer your question. And I don't know if you're asking September, October, just because we're in September and what follows September is October, or if you're asking that because of maybe the elections in the US, or this is just you saying, what's the 30, 60-day outlook? So I don't necessarily ask myself those questions. Now, as I look at the SPY here, I can see it broke above this. And so one of the things that I do is, like, I assume it's always going to come back and test a breakout. And when I say always, doesn't mean it always will. But let's say this breakout on SPY was 335, which the screen might be small for you guys, but it's 335, right? It's kind of a range of 330 to 335. So when I see something break through resistance, I just assume it's going to come and retest it, right? So if you look back here in 2018, clearly it did not stay above that. And so when it finally broke above it again, one of the things I thought was, oh, well, I'm going to expect it to come back and test that and test these two down here. And so at the end of 2018, not only did it come back and test this, right? If you look between here and here, it actually did test it, right? If you see that, these three right here, but then it also came back down here, tested here, went right through this. And so when someone asks me basically, what do I think of the next 30 to 60 days, which is how I'm reinterpreting your question, is the first answer I will actually say in my brain is, I don't know. Like I'm not expecting anything is really the answer. But I don't want to necessarily say that first to turn you off by that question. But I believe we should expect less from the market and be trained more to just hang out with the market. So if the market's going higher, we can yell and complain that it's going higher, or we can just go ahead and do what it's doing. I hope that makes sense. I think, thank you for asking that question, Olga. Okay, let me go over to my list. Larry, I see that you asked a question too. I also am going ahead and unmuting you on my side, so you can unmute yourself on your side. And Larry, your question is, would you use options to hedge in the event of a major correction, or would you buy gold as your hedge? The answer is I would do neither. I don't believe hedging is based on an asset. I don't believe gold is a good hedge. To me, a hedge is a strategy. A hedge is an approach. A hedge is not an asset. And I'll show you what I mean by that. So if I pull up a price chart of gold, and I'm going to zoom way the heck out, and I'm going to go look at a 50-year price chart of gold. So this is the actual price of gold. Now, this gold price chart is priced in US dollars, okay? But I will still be able to prove my point. So between 1980 to March of 2001, let's just call it 21 years-ish. Having money in gold slowed the growth of your choices and wealth and certainty and confidence and comfort. So owning gold for that 2 decades was a really bad idea. Owning gold basically between 01 and 11, that decade, was a really good idea. Gold wasn't the magical part of the hedge. The hedge was actually, and I'm not showing it on here, the hedge is knowing whether you should even be in the hedge or not. So to me, the best hedge is a strategy that is detached from whether it goes up or down, right? So one of the things I train my clients to do is when they own the S&P 500 to own it in a detached way, to almost practice not caring whether it goes up or not. I hope that makes sense to you, Larry. So, and I don't use options. I think options are a way to create complexity and complication in someone's life and have them feel like they're doing a lot more, because it's really not a feeling they actually are doing a lot more. So I don't believe options are a great way of growing stability and consistency. And I've shown in past videos how even covered call options are a way to slow down the growth of your money. Okay, let me just cover one more, and then I'm gonna hit the pause button here. This was asked in a couple different ways from you guys, so I appreciate this. When should you consider moving from one asset class to another, if ever? So that was asked a couple different ways. Kevin, you asked that. And so, first of all, if ever, I don't believe we should fall in love with asset classes. I believe we should fall in love with the black line going up and to the right. So there was a paper in 1986 that basically proved that the asset you own represents 93.6% of all of your performance. Meaning if you own stock, just having your allocation to stock is going to represent how well you do. Now, there are very simple ways to increase the returns, whether you're international or domestic, but stock over bond, 2 different asset classes, the money in stock represents 93.6% of your performance. The other 6.4 is what sector or what subsector or slice or segment you are in. So I absolutely do think you should move from one asset class to another, but the stock asset class is beating the other major asset classes, which are, depending on how you measure them, currency and bond, which I sometimes call fixed income. Then you have commodity, and then you have real estate. Real estate to me is actually owning something that if it dropped on you, it would hurt. So land, investment property, house. That's what I mean by real estate. I don't mean a ticker symbol. I don't mean a REIT. I mean an actual physical entity is real estate. So when should you consider moving? The answer is when the asset class you're in is falling in price and falling in price relative to the other major asset classes. And so what you get is let's just say the stock market falling in price and falling in price relative to the other major asset classes, which the easiest way is to just measure it against the bond market. And so you could do that. So thanks, guys. This, again, is a test to see if you like being able to call in and ask questions live. I know at least the ones that called in and emailed your questions in, most of you, the mics weren't working. So if you do want to call in, I think the best thing is to have a little back and forth like Ed and I had. It makes it for better listening. But we'll see if this is something that works for you guys. And so I'll get this kind of cleaned up and we'll send it out on Saturday. I hope you guys have a great rest of the week, and I look forward to connecting with you on the next video. Okay, thanks so much, guys, and I will talk to you soon. Okay, bye.